If you hold silver, you need to hear this right now because month end is not just a date on a calendar. It's a stress test for the entire financial plumbing system. And in silver, where paper claims are massive and physical throughput is slow, month end is exactly when the gap between what exists on screens and what can actually be sourced gets harder to hide. This week, the unusual part is not simply price. The unusual part is how the market is treating time. Immediacy is getting repriced quietly. That matters because in commodity markets, time is the first thing that breaks before price does. If the system starts paying even slightly more for metal now than metal later, it's not screaming default, it's whispering preference. And preference becomes pressure when everyone realizes they need the same thing at the same time. Month end concentrates that realization because balance sheets get cleaned, contracts roll, funding lines get reviewed, and risk managers ask one brutal question. What do we absolutely need to settle, and what do we only hope we can roll? That's where the word catastrophe enters the conversation. Not because catastrophe is guaranteed, but because the system becomes vulnerable to small frictions at exactly the wrong moment. And silver is one of the best markets on earth at turning small frictions into big moves. Why? Because silver is not one market. It's three identities fighting inside one price. It's an industrial input with real demand schedules. It's a monetary hedge that reacts to trust and currency risk. And it's a liquidity proxy, a place where participants park exposure, hedge, and sometimes get forced out when margin tightens. That combination means silver can look calm until the mechanics underneath begin to strain. And this week, there are signs of strain that don't make headlines the way you'd expect. No dramatic press conferences, no flashing alerts on mainstream TV, no official admission that anything is wrong. But the background signals, the ones professionals watch when they trying to decide if the system is comfortable or tight, started to line up in a way that usually only happens around pressure points like month end. You saw continued tightness in deliverable pools relative to the paper size of the market. You saw behaviors in spreads that hinted at the value of near-term availability. You saw physical premiums in multiple regions refuse to cool the way they should if everything was relaxing smoothly. And when those signals cluster, the market is telling you something. It's telling you that the next available ounce is becoming more important than the theoretical ounce. And markets don't wait for the world to run out. They reprice when marginal availability gets inconvenient at the exact moment demand needs to be satisfied. You don't need no silver exists for the price to move. You only need the next bar is harder to source than expected. That's how these moves start. And month end is the exact environment where sourcing difficulty becomes visible because cash, collateral, and settlement timing all get squeezed into a smaller window. Now, let's address the emotional hook in the title. Banks can't deliver. Prices to 100 plus tomorrow. Is that a guarantee? No. Markets don't hand out guarantees, and anyone claiming precision on timing is selling confidence, not analysis. But could silver print an aggressive move into triple digits quickly if the plumbing tightens at month end? Absolutely. And you don't need conspiracy for that. You just need incentives. Incentives do the work without announcing themselves. When carry costs rise, rolling becomes less attractive. When financing becomes more selective, inventory becomes more valuable. When physical holders see stress, they get less eager to sell cheaply. And when paper positioning is large, even a modest wave of forced adjustments can cause a jump that looks irrational to anyone who isn't watching the mechanics. This is why the most dangerous mistake you can make right now is to judge this setup only by the chart. Charts show you the argument after the fact. The plumbing shows you the pressure while it's building. The story here is not silver is about to explode because of a headline. The story is silver is entering a timing window where the system S assumptions get tested. Assumptions about liquidity, assumptions about smooth settlement, assumptions about how easy it is to roll obligations forward, assumptions about how much physical is actually willing to move at the prices the paper market implies. If those assumptions hold, the market breathes. If they wobble, even slightly, the adjustment won't come politely. It will show up as gaps, volatility, and suddenly a lot of people talking about silver after it already moved. Silver has always been that kind of market. It stays boring long enough to train disbelief, then it moves fast enough to punish anyone who ignored the signals. And month end is when disbelief is most expensive, because that S, when the market stops asking what you think and starts asking what you can actually settle. To understand why month end can turn into a silver shock, you need to understand how modern markets actually function. They run on leverage, collateral, and confidence, stitched together by smooth financing channels that everyone assumes will remain smooth. When those channels get even slightly less cooperative, the market doesn't break in a cinematic way. It tightens. It becomes selective. It starts charging you for speed. And speed is exactly what month end demands. Month end is when portfolios are rebalanced, exposure is trimmed, funding is reviewed, and risk limits are enforced with a seriousness that doesn't always exist mid-month. It is when the nice-to-have positions get cut and the market must settle out. Obligations get prioritized. That is why silver is so sensitive here, because the paper market is huge and liquid, which makes it easy to trade, but the physical side is slower, smaller, and constrained by logistics, financing, and willingness to sell. When the system is calm, those two worlds coexist. When the system is under stress, they collide. Now here lacks the key mechanism that can turn a normal month end into a violent repricing, margin, and collateral efficiency. When volatility rises or correlations change, margin usage jumps, not just in silver, across a portfolio. And when margin usage jumps, the question becomes, where do we reduce exposure to survive? This is where people misunderstand the phrase global margin call. They imagine a single event where everything collapses. In reality, it often begins as many risk managers making conservative decisions at the same time. If those decisions cluster within a short window, the effect feels sudden. Silver is particularly vulnerable to this because small changes in funding cost, roll efficiency, or spread behavior can force large players to alter positioning fast. And because silver's market is relatively small compared to global capital, the flows matter more. There's another layer people don't talk about enough: the difference between paper liquidity and physical liquidity. Paper liquidity can look endless on a screen. Physical liquidity is constrained by time, by transport, by vault capacity, by financing, by the willingness of a holder to part with metal. When month-end pressures rise, the market starts asking for physical-like certainty even from paper exposures. People don't need to demand delivery to change the game. They only need to model delivery as a credible option, and that modeling alone shifts behavior upstream. They roll earlier. They tighten risk. They pay up for immediate settlement. They widen spreads. They reduce the appetite for being short, near-term metal in a way that might require sourcing it under pressure. In other words, they price immediacy. And that's exactly what this setup is signaling. Immediacy is being repriced quietly. You see it in how the curve behaves. You see it in how near-term settlement feels valuable. You see it in the stubbornness of premiums and the reluctance of physical to loosen even when macro narratives try to calm everyone down. This is why banks can't deliver becomes a meaningful fear at month end. Not because every bank is going to fail, but because the system's smooth functioning depends on the assumption that obligations can be rolled, netted, and settled without forcing too much physical metal to move. When the market becomes sensitive to that assumption, short positions become riskier and long exposure becomes more valuable, especially long exposure that does not rely on a counterparty promise. That's the deeper story behind the emotional headline. The real question is not, are the vaults empty? The real question is, how much flexibility exists at the margin right now? How many pathways exist to satisfy near-term demand without touching the tightest pools of metal? How elastic are those pathways if financing becomes selective for a few days? How many participants are positioned in a way that assumes the path will remain smooth? Because month end is when smooth paths become narrow corridors. And narrow corridors create price jumps not because the world ended, but because too many people tried to move through the same corridor at once. If you want a mental model, think of it like this. In calm periods, the paper market is a wide highway, and the physical market is a slower side road. You can pretend they're the same because the highway is open. When stress rises, the highway gets tolls, lanes close, and suddenly everyone realizes the side road is the real constraint. Price doesn't respond to the average condition. Price responds to the bottleneck, and month end reveals bottlenecks. Now let's move from financing into flow, because the most interesting silver stories are rarely price first, they're flow first. Price follows flow with a lag, and sometimes that lag ends violently. The reason is simple. Flow is reality. Price is negotiation. This week, the flow story is uncomfortable because it hints at timing mismatches and thin buffers at the exact moment month-end settlement prefers buffers to be thick. Publicly visible exchange data continues to show tightness in deliverable pools relative to open interest. That's been discussed for years, sure, but what matters is context. This is the period when near-term settlement demand typically eases and the market breathes. If instead the market behaves like it has very little cushion, that's not a normal signal. Spreads hinting at stress, even subtly, are the market's way of saying availability now is slightly more valuable than availability later. And in commodities, that's the earliest language of constraint. Physical premiums matter here because they are the physical market's vote. They're not ideology. They're not social media. They're not bullish vibes. They're what buyers are willing to pay to secure metal within a time window. When premiums refuse to cool, it suggests buyers care more about certainty than price. And month end is a period when certainty becomes priceless to certain participants. The industrial side of silver does not politely pause because the curve looks uncomfortable. Solar supply chains don't pause. Grid infrastructure doesn't pause. Defense applications don't pause. Electronics manufacturing doesn't pause. These are schedule-based demand channels. They plan, they procure, they secure inputs. If procurement teams sense that lead times may lengthen or financing may tighten, they pull forward demand. Not because they're panicking, but because buffer inventory is cheaper than disruption. That behavior can tighten a market without any dramatic headline. Now add the structural supply issue. Most silver production is byproduct production, which means higher prices don't instantly create more supply. This is not oil. You can't flip a switch and flood the market. Higher prices can encourage recycling and marginal expansion over time, but month-end doesn't care about over time. Month-end cares about what is available right now, under current constraints, with current financing, with current logistics. That's why the marginal ounce matters. This is where the paper-to-physical relationship becomes critical. Paper-silver volumes are enormous relative to physical throughput. That's normal until it isn't. In calm periods, leverage and netting mask mismatches elegantly. In transitional periods, those same features magnify small frictions into visible distortions. You don't need a rupture, you only need friction. A small delay in sourcing, a slightly higher financing cost, a slightly wider haircut, a slightly more cautious balance sheet allocation, a slightly more reluctant physical holder. Those slightly factors are what create big moves when they align, because they change behavior across many participants at the same time. Silver is famous for false starts. That history trains people to fade signals, to assume rallies are traps, to assume the metal will disappoint. That psychological conditioning is a real factor right now because it misaligns expectations. When a market teaches people not to believe it, it gains the ability to surprise them later. Surprises are not guaranteed, but misaligned expectations are the breeding ground for asymmetric moves, especially around settlement windows. Now, does this mean silver must hit $100 tomorrow? No, that would be irresponsible certainty. But does it mean the probability of a sharp, news can't explain it, move increases when month-end meets thin buffers and repriced immediacy? Yes, and that's the point. The setup is about vulnerability. Systems that rely on confidence can absorb a lot until they can absorb quite as much as they did yesterday. When that boundary is approached, markets don't announce it with a press release. They show it through odd spread behavior, stubborn premiums, tightening financing, and increased sensitivity to the cost of waiting. The cost of waiting is rising. That is a quiet but powerful signal in the silver world. Let us talk about the players who can turn a tight month-end into a violent move, positioned paper participants, and the risk control machinery around them. This is where the banks can't deliver narrative becomes dangerously simplified, because it's not about a single villain. It's about an ecosystem where incentives collide. Paper participants rely on rolling, netting, and liquidity. They rely on the assumption that they can unwind positions when they want at acceptable slippage, because the market will be there for them. Month-end is when that assumption gets tested, because balance sheets become more selective and liquidity can thin at exactly the wrong time. If short-term volatility rises, or if correlations spike, margin frameworks adjust. Haircuts widen. Options hedges reprice. Funding desks become cautious. And when that happens, the same paper exposure that felt efficient on Tuesday can feel toxic on Thursday. The market doesn't need anyone to fail. It only needs enough participants to reduce risk simultaneously. If that cluster happens, price can gap because depth isn't there. When depth isn't there, price moves until it finds it. And if the move is upward, shorts become fuel. This is how squeezes happen without a conspiracy. They happen because a short position is a promise to deliver or settle under conditions you deny T control. If conditions tighten, that promise becomes expensive. In month-end windows, the cost of being short near-term metal can rise fast. Not necessarily in interest rates you see on TV, but in the micro costs of rolling and financing and managing settlement risk. If those costs rise, shorts cover. They don't cover because they changed their mind. They cover because the position's risk reward got worse. This is where the phrase, "can T deliver?" should be translated into a more accurate statement. Delivery optionality becomes more valuable and more sensitive. When delivery optionality becomes sensitive, paper claims become less comfortable to carry, and the market reprices that discomfort as volatility. Options markets often sniff this first. When participants pay up for protection without a corresponding explosion in realized volatility, it means uncertainty is being hedged before it becomes visible. That hedging can feed back into futures through dealer hedging flows, which can accelerate moves when price starts to run. ETFs and systematic vehicles can amplify too, not because they're malicious, but because they respond to flows and rules, not judgment. If inflows hit during a thin window, they can force sourcing and repositioning that pushes price harder than people expect. Now add a psychological element. Mainstream coverage rarely follows silver until the move is underway. That means the first phase is driven by structure, not narrative. Structure moves fast because it's mechanical. Narrative moves slow because it's human. By the time the narrative catches up, the move often looks obvious, which is why people chase late and then get shaken out. Silver is built to do that. It punishes late certainty. It rewards early attention to mechanics. Month-end creates a stage where mechanics can dominate briefly. That doesn't guarantee direction, but it increases the chance of disproportionate motion if a trigger occurs. And triggers don't need to be dramatic. A routine policy tone shift, a modest data surprise, a technical adjustment, a funding hiccup, a marginal shift in risk appetite. These are gentle nudges that become loud when the table is already tilted. The title says, tomorrow. What matters is not the literal clock, but the window of vulnerability. Month-end windows compress decisions. Risk managers become more active. Carry costs get reviewed. Hedging flows cluster. Liquidity becomes conditional. That is the environment where silver can leap in a way that makes $100 feel like it appeared out of nowhere. And when that happens, everyone will pretend the headline predicted it. But the truth will be simpler. The mechanics tightened and price was forced to catch up. So how do you navigate this without falling into the two traps silver always sets? Blind certainty and blind disbelief. The goal is not to predict a single outcome with fake precision. The goal is to understand the stress map. What breaks first if pressure rises, and what signals reveal that pressure before price screams. First, watch immediacy signals. How the near-term market behaves relative to later periods. If the market keeps paying a premium for now, that's a sign of preference shifting towards certainty. Second, watch physical behavior. Premiums, lead times, dealer availability, regional tightness. Physical is slower, but it tells the truth about practical availability. Third, watch financing sensitivity. If volatility rises and margin frameworks tighten, paper exposure becomes less comfortable and the adjustment can be sudden. Fourth, watch liquidity itself. Do moves happen on thin depth? Do dips get bought instantly? Do spreads behave oddly? These are tells that the market's shock absorbers are weaker than usual. None of this requires believing the world is out of silver. It requires acknowledging that buffers can be thin and that thin buffers create asymmetric responses to small triggers. Silver's market is a negotiation between industrial need, monetary uncertainty, and leverage mechanics. When those forces align, even briefly, price can move faster than people's models can handle. That is why the phrase month-end catastrophe resonates. It's not a promise of doom. It is a warning that the window is sensitive and the system is less forgiving than it looks. If the system clears smoothly, tension can dissipate for a while. If it doesn't, the adjustment won't arrive with a polite explanation. It will arrive as a gap, a sudden spike in volatility, and a scramble for narrative after the fact. And here is the deeper lesson that separates people who survive silver from people who get wrecked by it. Vehicle choice matters. Leverage turns volatility into existential risk. Physical holders, by definition, are less exposed to margin calls. They're not forced out by a broker. They can sit through the violent part and benefit from repricing when paper is forced to admit tightness. That doesn't mean physical is magic. It means it's resilient in a regime where liquidity is conditional and risk managers dominate decisions. Silver's reputation for false starts is real, and it trains people to dismiss signals. That training can become a trap when the signals finally matter more than usual, because expectations are misaligned and positioning is wrong. That's where asymmetry lives. The market doesn't need everyone to agree. It moves when agreement breaks down and confidence becomes conditional. Month end is when confidence gets audited. Finally, let S anchor the emotional claim of 100 plus in the only responsible way. As a scenario, not a guarantee. If the month-end window forces paper adjustments while physical remains stubborn, a fast repricing into triple digits becomes plausible because the market is small enough for flows to matter and tight enough for immediacy to be repriced. That repricing can happen quickly, and it can feel disproportionate to whatever news people cite after the fact. But the story will not be the news. The story will be the mechanics. This is a market that moves when few are watching, then becomes the conversation when it's already moved. If you want to be early rather than late, stop staring at the headline price and start watching what's changing underneath it. Because the moment you can't unsee the plumbing signals, the repriced immediacy, the thin buffers, the margin sensitivity, the conditional liquidity, you realize the real risk isn't missing a prediction. It's ignoring a window where small triggers can have outsized effects. That's what month end is in silver. And whether the move happens tomorrow or next week, the setup is the same. When mechanics tighten, silver doesn't whisper for long before it speaks.